There can be situations where there is a stock-for-stock deal where a taxable transaction might be desired. We've had, particularly post-COVID, where shareholders might have losses.
Joining me today to talk about transactions in the REIT market is Kendal Sibley, partner with Hunton Andrews Kurth. You participated on a panel here at REITwise focused on REIT M&A. What are the biggest tax considerations that have come up in the last year or two in terms of REIT deals?
Well, the first thing that you have to figure out when you're doing REIT M&A is whether you're going to have a taxable deal or tax-deferred, at least first from my perspective. This is a big difference for the shareholders, and there are some situations where it's going to be taxable, a take-private, where the shareholders are getting cash. So there's not a lot of tax analysis to do. That's taxable. But there can be situations where there is a stock-for-stock deal where a taxable transaction might be desired. We've had, particularly post-COVID, where shareholders might have losses, and the acquirer wanted to get a step up in basis in the assets, and so a taxable transaction actually made sense for the parties, even where stock was a consideration. And so there are ways to structure that, but knowing that at the forefront allows you to structure it efficiently so you're not tearing up your slides halfway through the deal.
Let's shift to talk about OP unit deals. What do you advise clients to expect in an OP unit negotiation?
So we see a lot of OP unit negotiations and fewer OP unit deals getting done. So a contributor, generally, we're talking about a person who has developed a property or a portfolio of properties. It's closely held, maybe a family that has been doing this for a long time. And generally, they have low basis, negative basis from a tax perspective. And so they're looking for tax deferral. Someone says, how about OP units? They say, this sounds fantastic. But then you get started and you layer in the complexity of the OP unit deals. You layer in the tax protection pieces where the contributor is trying to tie the hands of the REIT in terms of what they can do with the property. And sometimes that works well. The REIT's planning on holding it for a long time and so is willing to give a long period of tax protection. I've seen, this is pretty rare, but I've seen tax protection until you die, which is the gold standard from the contributor standpoint because they get a step up in basis on death. Typically you see 5 to 10, 7 is not uncommon. So that's not forever tax protection. So it's not forever tax deferral, and you lose, as a contributor, you lose a measure of control. The other thing you see in those negotiations is the contributors tend to think of partnership as being one where they get a say in the decisions, and that's typically not the case unless it's a super large portfolio where they're getting perhaps board observer rights or something like that.
Finally, what have you seen in terms of any innovative deal structures, or is there a trend or two that you see emerging over the next few years?
So there have been a couple of innovative structures recently. I spoke about one of them this morning with REIT and Realty Income when they merged and did a simultaneous spinoff of the office properties to create 2 pure play REITs, retail for the surviving Realty Income, and office for the Orion Office REIT. Another innovative transaction that we've seen in the market is where there is a asset sale contemplated as part of the transaction. So REIT and Realty Income involved a spinoff. We also see mergers where there's an asset sale to a third party generating a portion of the cash. So you saw that with Columbia. There was a portion where there was an asset sale piece, and then there's some other transactions that are ongoing that are contemplating similar structures. Essex BRE did it several years ago, so it's not totally new, but innovative, creative, a different way to get the consideration in the hands of the shareholders.